Wall Street is the most bullish on commodities in at least a decade. Now, Wall Street has a propensity to chase what is already going up. After all, on CNBC, there is a show called Fast Money, and one of the people on Fast Money pretty much every day wrote a book called How to Buy High and Sell Higher. So anything that's already going up, and commodities, except for gold and silver, and gold has been dealing with a bunch of paper price smashes. But in general, over the last 6 months, commodities have been doing very, very well, except for gold, which has gotten paper price smashes based on a weak dollar index. And the dollar index has been very weak, barely holding above 90 now and threatening to break out of its 5 or 6 year trading range. And also because of China, which instead of recycling trade surpluses into US Treasuries, China is stockpiling massive amounts of food, energy, and industrial metal commodities. However, not gold, as far as we know yet. We have not seen any data that the People's Bank of China did a massive purchase of physical gold. But if the gold price continues to act weak, we may see that in the months to come. But commodities, except for gold, have had a very big rally recently. Let me read this Bloomberg article. Commodity investors are back in full force with record wagers that crops, metals, and oil are set for a rally. A weakening dollar, although the dollar has had a little bit of a rally recently. We'll see if it lasts. It's only a tiny little rally. A lot of it is because there's been a spike in the 10-year U.S. Treasury yield. Again, the U.S. federal government cannot afford a lot higher interest rates, as the interest expense on the ballooning national debt and the budget deficits exploding, and the demand for U.S. Treasuries relative to supply. The demand is definitely in question, and the supply is not going to be cut back, especially if Bernie Sanders is the budget director. A weakening dollar is making materials denominated in the currency of US dollars more appealing at a time when equities are on a tear and the world is on a path to recovery from the pandemic. All that has prompted speculators to pile back into commodities markets, boosting combined bets on rising prices to the highest in at least a decade. That's a stark turnaround for a corner of the financial market that has been struggling to lure investors since the China-driven commodities supercycle earlier this century. Now, many of you may have remembered that was after China joined the World Trade Organization, and they still aren't in compliance with that. And we had a big commodities bull market for many, many years when the gold price went from the Gordon Brown bottom of around $250, give or take, when the central banks, the Bank of England and Canada, they sold all their physical gold, and that marked the bottom. And then I think the gold price rallied from about $250, give or take, or $300 in that trading range. It was stuck there for a while. The mine supply was dwindling. The same thing for silver. Silver was stuck at around $3 and couldn't get up above that. And then these things just started taking off until during the 2008 financial crisis, when they crashed, and there was a massive crash, and then there was an enormous stimulus by China. And from 2009 to 2011, you had a combination of a very weak dollar on the dollar index and an enormous amount of infrastructure spending by China. And that drove commodity prices, an enormous rally in commodities, including the gold price, copper price, you name it, pretty much all the commodities with a weak dollar. And in the supply-demand fundamentals, especially demand driver from China and supply, there had to be a higher price for supply and demand to balance on a lot of these commodities. But we really hadn't seen for a lot of these commodities a bull market or consistently higher prices for a long time. And I'll talk about that later in the article, especially with the grains and soft commodities. China-driven commodity supercycle earlier this century. The backdrop is looking familiar. The Asian powerhouse is on a buying spree again, and investors are looking for alternative places to put their money as central banks try to prop up the economies. Quote, commodities are on a winning streak right now, said Michael Salden, head of commodities at Vontobel Asset Management. Quote, markets are rallying due to the combined effect of U.S. dollar weakness, the cyclical recovery from the pandemic, central bank stimulus, and increased fiscal spending on infrastructure. Investors are so bullish but shockingly, even though people have more inflation expectations, the paper gold price just continues to get smashed. I think at one point in a 3-day span, it was down $110. That's how ridiculous the paper gold price is smashed, despite a weak dollar and despite inflation expectations starting to pick up with rising bond yields. And potentially out there, my friend Peter Bookvar just put out an article saying he thinks that the CPI, the Consumer Price Index here in the U.S., might go to 3% in the not-too-distant future. officially, which would be pretty shocking for me, but maybe. Investors are so bullish that they were holding a net long position, or the difference between bets on rising prices and wagers they will fall, of 2.3 million commodities futures contracts and options contracts in the week ended January 5th, according to data compiled by Bloomberg. That's the most since at least January 2011. The calculations include 20 of the 23 raw materials in the Bloomberg Commodity Index. They exclude aluminum, zinc, and nickel, which are reported by the London Metals Exchange on a different basis. Money managers' bullish bets on corn are currently at the highest in almost 10 years. China is loading up on American crops because they had an enormous flooding and other problems with their weather that I covered in the last 6 to 8 months on my YouTube channel and prior videos. You could look those up in the archives. Having already bought a record amount of the grain, while soybean purchases are running at the fastest pace since 1991. Sugar has also caught investors' attention, with Alvin, the world's largest trader of the sweetener, forecasting 2 years of sugar shortages ahead. So I'm sure Jim Rogers would be happy about that. By the way, if you want to take a look, I have a Patreon account article from May 14th, 2020, where I talk about one of the safer ways to have broad exposure to commodities, and it is not DBA or some of these other commodities ETFs. There are a lot of the main commodities ETFs are improperly misweighted, and they have bad misweighting, mostly to oil and some other commodities, and they're not balanced. Unfortunately, the Rogers Raw Materials Index does not have an exchange-traded fund as of now that tracks it, and that, in my opinion, has the best weighting, and he only has a mutual fund. But I do have in this article, if you want to read it for $5 a month behind the paywall, the May 14th, 2020 article entitled, "Definitely Not the Best Way to Play the Eventual Rally in Commodity Prices." So I did see that there was going to be a rally in commodity prices, but this commodities ETF DBA, in my opinion, the weighting of it is not good. The similar commodities ETFs that are similar to the Rogers Raw Materials Index, because there is no ETF or exchange traded fund that tracks exactly the Rogers Raw Materials Index. There's only mutual fund, but there are similar ETFs that I highlight in the article. There's charts in there to look up for lower expense fees, and then have weightings, more weightings to some of the other commodities, like more industrial metal exposure, more agriculture. They're more balanced than a lot of the more mainstream commodities ETFs. Some of them even have large U.S. Treasury exposure, as I highlighted in the article, which is kind of ridiculous. For one of these commodities ETFs, shockingly, its largest holding was U.S. Treasuries. You can't make this stuff up. Okay, back to the article. Even grains that had been on a downward path since 2012 have rallied more than 45% over the last 6 months due to La Nina-related droughts in Latin America, Sullivan said. He also highlighted China's role in securing strategic reserves of commodities. Oil, which was rebounding from an unprecedented crash triggered by the pandemic, has rallied on two 10-month highs after Saudi Arabia did a surprise oil production cut and unilaterally cut production by 1 million barrels per day for February and March. The rally has also extended because if you go back and look at my video for the last couple weeks, that shows that demand is still very weak, so they cut supply too to try to balance things out further. The rally has also extended beyond headline crude prices and into options and signs of strength on both ends of the oil futures curve. Speculators boosted bullish bets to Brent crude to an 11th-month high, while net long positions in gasoline climbed to a 10-month high as well. Again, I don't think this is based on demand. I think they're betting probably on more supply cuts and weak dollar. China has done an insane amount of oil stockpiling as they keep building new, more and more strategic petroleum reserves. I think there's over 5 now in China. Quote, crude oil looks like a great play as the economy reopens, demand picks up, and people build confidence around the potential vaccine, said Phil Strabeel, chief market strategist at Blue Line Futures LLC in Chicago. I'm not sure if I agree with him on that because I haven't seen anything in the data so far that's showing that demand is actually picking up. So just because oil price is rising, it's not, as far as I can tell in the data, on demand increasing. It's mostly on more and more supply cuts, and also on a weak dollar. Saudi Arabia really bent over backwards to try and help support prices. Bets on rising gold prices rose to a 16-week high, and platinum net longs are at the highest since February. Investors also boosted net long position bets on silver for the 5th week in 6. So that's the end of this article. But again, paper gold and silver futures contracts, they are manipulated. They are in a manipulation correction. Eventually, this correction will end and we will go higher, especially if the dollar continues to be weak and people start to get inflation concerns. I was around during the last major commodities bull market from 2009 to 2011, and gold and silver were leading the charge. So I would be shocked if gold and silver do not play some catch up in the next 6 months, perhaps sooner than that. And don't forget to check out that Patreon article if you want ways to have broad commodities exposure with a commodities ETF that has exposure to agriculture, industrial metals, and energy. Please consider becoming a patron over on my Patreon and chipping in $5 or more per month, so that way I can continue to do my research and make unique content and be able to make a living. Because with my YouTube channel, my Google AdWords revenues have collapsed almost to zero. My YouTube channel subscribers have stopped growing in the last 9 months. There's no growth there. And my live stream shows have been shut down, and YouTube tech support is giving me all types of excuses, claiming that they did not put a strike on my account, even though I can't edit the title for a live stream show. I cannot turn monetization back on. I cannot even turn live chat back on. That's how bad things are with the live stream show. I have almost 150, and hopefully soon it will be over 150 unique pieces of content behind the paywall on Patreon in terms of well-researched articles. Some of the articles have taken me many, many hours to produce for lots of different topics about gold miners, silver miners, precious metal royalty and streaming companies, a lot of articles about the oil industry and other commodity industries, also global macro related articles. There's also audio podcasts on a lot of stock charts and technical analysis there too. And while you are getting unique content, if I go over 1,200 patrons and I stay there, I will sign up for another live streaming service just for patrons. So I will make this pledge, I will make this promise. If I go over 1,200 patrons and I stay there, so if I drop below 1,200 patrons, the promise is not going to stay. I have to stay at 1,200 patrons and stay there. I will start to do live stream shows just for patrons behind the paywall there. Will require additional capital. I will have to sign up. I think it's $100 a month for another service there to integrate with Patreon, to sign up there and integrate. So that will be an additional added bonus for patrons if you want to take me up on that. But please chip in if you can, as YouTube is basically trying to make this impossible for me to grow my channel or to make a living from making content.